Welcome to the ScaleUp Valley podcast, where we bring the best founders and investors to help you scale a business from 1 million to 1 trillion. Today's guest is Alex Mifsud, the co-founder and CEO of Weavr. Alex, welcome to the show.
Thanks for having me, Mike.
It's really a pleasure and a testament for our perseverance, because we have tried to record this podcast for a very long time, but we never give up, and we are doing this now. But for the ones who didn't have the opportunity yet to meet you before, who is Alex?
Well, where do I start? I guess the last 20 years of my life has been building businesses, mostly in financial services and payments. But before then, I spent quite a bit of time working as an academic. I'm a computer scientist originally, well, an engineer and then a computer scientist. I really enjoyed time in academia, where you're really spending a lot of your time thinking about what's possible, how to make things work. Really also interacting with some great minds, established minds, but also minds in formation. I think that transition to me was painful, but also really exciting, from being an academic, thinking about how to come up with new concepts, how to make them work, and then eventually, how do they actually affect people's lives, right? So that's been kind of my transition, if you like.
Right. And for the ones who are just getting to know more about your background, would think that you have always been related to academia and you are starting your first company, but that's not the case. This is your third company. How has been your journey so far with the previous companies, and how did you end building Weavr and starting up Weavr?
Yeah, look, my first experience of building companies was in the early noughties. I had some ideas that actually came from my research work with some of my students, and of course the original idea never quite made it to become the business. But the first business ended up actually creating the world's first virtual prepaid card business called Entropay. And at that point, I think I was a decent technologist, but I was certainly a bad business person, and I made all the rookie mistakes of building a business, thinking that clever tech is enough, thinking that basically just ignoring the risks generally. I first experiences with payments were having the big lesson of fraud, right? You think everything's working brilliantly, you see all those nice curves going up, and then you realize you have a fraud problem, and that fraud problem is going to kill you, basically. Right. So that's I think the early sort of years was almost like a learning ground. I didn't go to business school. I went straight from being an academic. Well, I spent a year and a bit in consulting as a transition. But then really I started trying to build a business. It was a learning ground for me, and it took longer, but at the same time we made it work. So Entropay had customers from over 100 countries around the world, and eventually we learned how to run it extremely efficiently using machine learning to manage fraud, and that business effectively was not really a venture-backed business in any sense, but really taught me about how to solve not just technical problems, but how to communicate value, how to do commercial deals, how to run marketing programs, and that's what I took into the sort of my next business, which a business called Ixaris, which I sold in 2021 to Neum. And that business took a lot of what was learned from Entropay. Actually, was also to an extent based on virtual cards or virtual payments, but targeted B2B. Actually, it targeted mostly large businesses, multinationals, paying suppliers. Mostly in the travel industry, but not exclusively. And ultimately, that the footprint of that business grew to 60 markets, processing in the billions of dollars.
Well
worth
done.
of transaction volume. And I think that's when I sort of started to see the pattern around what product market fit looks like. And the Entropay business, product market fit, was very surprising for me that when it happened, and suddenly this growth started to happen, and I just couldn't figure out why. What had changed? And in retrospect, it was finding product market fit. In the Ixaris business, I set out looking for product market fit. And having tried really tried to apply virtual cards in a whole range of sectors. I remember this one time when we looked at all the different use cases: payroll, insurance payouts, travel payments. There was like sort of five categories, and travel was about 5 times all the others combined in terms of volume.
Got it.
And I didn't know why. I went to speak to customers, so I really understand why they're using these things. And my assumptions were completely incorrect at the time. When I realized what it was, we then started making the product really work for that particular use case, and we got that exponential growth. Of course, the pandemic then changed the trajectory a little bit, right? But certainly the underlying fundamentals were there and still continue to be there for the business that has been acquired.
It's growing even more now.
Absolutely.
That is great. And it's incredible what you were talking about, that you went from a technologist that didn't know too much about business. You have learned your way, and then you were able to create a success case before starting Weavr. And of course, now you are in a great journey with Weavr. And it's curious to see that now you are much more. You also have a CTO in the business, so you were not one of those technologists that would say, "I don't need a CTO. I can be the CEO and the CTO." And sometimes I'm joking, but I still see some of this happening nowadays in companies, because being the CEO, also having the technological background, sometimes there is the temptation of, yes, I will accumulate both roles, the CEO and the CTO role, especially in the first year. But it seems that you were quite clear about, I will be the CEO and I need to have a CTO at my side.
There's actually there's more to that than what you're saying is absolutely right, but there's a little bit more in our case. My co-founder, Adrian, actually, I've worked with him in the Entropay business. I think he was employee number 4 in that business.
Oh, great story.
And then he worked as CTO at Ixaris, my second business. And he left to do a PhD. So he left when the business started actually growing. It's actually at that point that he left to do a PhD. And he finished his PhD in 2019, just at the time when I was thinking about setting up Weavr. And I was really worried, because I was thinking, here's a really complex technological journey that we need to go through. But at the same time, there's a very embryonic market. You can't sort of just slot into existing demand. How am I going to make this work? And Adrian was like the perfect co-founder I could have thought about. And, I called him and he very quickly said yes, actually. And so I feel really lucky to have had that privilege.
That is definitely important to know. I'm just thinking about raising a pre-seed with previous experience in the industry, in the space, and with a team that has been working together in the last 2 ventures and is going for the 3rd venture, and with a very strong technological background and R&D background, and that helps in terms of raising your initial rounds, right?
It absolutely does. Having said that, you still need to shape your ideas, right? And in fact, Adrian and I, when we decided to do it, we're sort of almost decided we're definitely going to go for it and make this work. So we decided, as a kind of test to ourselves, to enter a pitch competition. And we did, and we won the pitch competition, which gave us our first 20 grand. Which is nice because it's a grant, right? It was a grant. Absolutely. And there was no sort of equity involved at that point. Yeah. And that just gave us, we would have done it anyway, but that just gave us the sort of sense that, we're keeping ourselves honest. We're having to sing for our supper, we're having to really sort of articulate the value rather than just trade on the fact that we've been experienced at business building before.
Right. And there is also something interesting that we will get there, which you were also able to raise with the Horizon 2020 program, which is quite complex to get in. But before that, let's get into 2018, December of 2018, when you decided to start Weavr. So what was Weavr about, and what is Weavr?
Well, Horizon 2020 is intimately connected with that point, because the original project was actually done through a Horizon 2020 grant within the Ixaris business. So Weavr didn't exist there, at that point. Ixaris really wanted to try and think about a next generation platform. Mm-hmm. And we had a ton of ideas. And I remember the engineers telling me, Alex, if you want to make these ideas happen, these are not incremental things. These are quite radically different in the way we've been building our technology. Give us a year to do nothing else but build this platform if you really wanted to do it on these sort of quite radical, radical departures from the way the original Ixaris platform was built. And I said, careful what you wish for. And I actually really drove this Horizon 2020 bid. I put a consortium together. Visa was part of that consortium, amongst others. Mm-hmm. And basically we got the grant. We got a €2.5 million grant for a €4 million project. And I got 25 engineers working for 2 years to build this operating system for originally embedded payments.
How many engineers, Alex? Sorry.
At the peak point, there were 25 engineers
25. Wow.
Working on the project, including support from Visa's technical architects.
Amazing.
We had lawyers really tell us whether something would make sense within the current and the emerging regulation. It was a very exciting, kind of intellectually rich project. And when we finished it, we had to sort of, by the time we finished it, Ixaris had product market fit in the travel sector. It was doubling every sort of 9 months in terms of volume and revenue. And the board said, well, do we really want to transition to some completely new sort of radically different platform?
Right.
And I said, at that time, I said, well, it probably doesn't make sense, but this is such a good sort of piece of technology. And I know the market isn't quite there yet, but it will happen. Uh-huh. And I made an offer to the shareholders to actually take the IP out of the Ixaris business, and that's been the genesis of the Weavr technology.
Amazing. So it's really an amazing story, and then you decided to focus on Weavr, and the project was, so what is Weavr today for the ones?
Yes. So look, December 2018 was simply when we set up a vehicle to take the IP.
Right.
There was no team, there was no operation. It was literally, okay, so now what do we do? We own the IP, we have no money, yeah. We have no staff. We have and throughout 2019, it was very much in the garage, deciding which bits of the code. Remember, this was a research project, right? With many hands have been involved in this. Even the sheer size of the code base was daunting. So we spent all of 2019 heads down, stealth mode, really cleaning out the code, trying to actually reduce the size of the code we would go live with, and shaping a product out of that technology stack. And then in 2020, when we really started seriously thinking about fundraising. And of course, the moment we were ready, we had a business plan. We started to go and reach out to investors in the beginning of 2020, and the pandemic hit. It was like a huge psychological blow for us, because at that point, we're just about ready to launch in beta, to start getting customers, to then get investors on board. We're still on a shoestring. Mm-hmm. And suddenly we're unable to use all the things we've learned about pitching to investors, about, going out there, doing demos, hustling with customers and so on.
Right.
But in fact, the world quickly adapted. What's amazing is that in the first 3 months of the pandemic, the world the digital world went from being completely in a panic to this is a new opportunity for digital like we've never seen before.
Mm-hmm.
And in fact, in July of that year, in July 2020, we launched our beta. And in November 2020, we launched our service. And we raised $4 million before we, in September of that year, to actually be able to fund the launch ultimately of the business. So we like to think of Weavr as having really started in the pandemic and launching publicly in November 2020.
You kind of were able to have that grant in the pitch competition after you decide to create the legal entity and leave the Horizon 2020, or as a consequence of the Horizon 2020 project, right? So I think that you were even able to raise the pre-seed round in 2019, and then 2020 the seed rounds.
That's right.
Right. And after that, you even extended your seed round in 21 with Headline. Right?
That's an interesting story, because Headline had been, we had to really decide how much of a size of seed round we raise, and we felt we didn't want to raise too much at the time. Obviously, not to give up too much equity, but also not to get lost, right? Because I think you need to really remain focused as a founder, and especially at the early stage of the business.
Yeah.
But what we found is that in the first quarter of 2021, we were staggered by the amount of demand in the market, and it caught us by surprise. We were sort of saying, well, it's going to take a while for the market to happen, and we did the first half year's target by the end of February, early March.
Wow.
And then we realized we have a problem here, because how are we going to implement and support these deals? Like at that point, we're still sort of, 5, 6, 7 people in the business. We have to build an organization that supports these live deals. And we did some maths and we realized if we did that, we would really start to run out of money quite quickly. And you don't want to raise when you're going to run out of money, obviously.
Right.
And the board said, our board said, basically, oh, don't worry, we'll put in a couple of million extra to give you that headroom. I decided, what, let's go and have that conversation again with all the investors we said no to in September. And we actually only spoke to 5 investors outside our cap table. And we got offers. We didn't get offers from all 5. We got offers from 4. And we loved sort of Headline. Actually, Michael Kent, who is the venture partner at Headline. I was really, I was sorry we didn't take their money, because he's such a great guy in terms of his experience in fintech, and just incredibly helpful. So we put that right in May of 2021.
That is quite amazing. So you said no to some people in your initial round of in your initial seed round in 2020, and after that you decided to come back to those people when your board and your portfolio of investors offered you to kind of extend or do a bridge round at seeds, and you were able to talk with the ones that you decided to say no to, and you were able to raise another 7 million pounds or dollars, right? Namely with Michael Kent from Headline. So amazing story, just highlighting how amazing it is, and especially that is the point of some of the best companies, right? It's the option to select your investors. It's much better to be in that position than just begging for an investor to invest in your venture, when you are in a position that you are able to choose who you want to partner with. That is definitely a great spot, or a great seat to be.
I think there is it's a really good objective test of whether what you're doing is right, to try to have choice. Because if you're desperate to get an investor over the line, exactly, and you might just find one that is willing to do it, this probably should be telling you something, right? You're either so far ahead of the market that only you get it and maybe a very, very tiny minority of people.
Exactly.
Or else you probably haven't quite dealt with all the angles. Because if you have and you've got something good, you should basically be able to be in a position to choose how you assemble your cap table.
Absolutely. And after that, you in February of 2022, you raised a $40 million A round with Tiger Global Management, right? So how has been the evolution from this second seed round that was higher than the initial seed round 4 to 7, and now the 40 million round?
Yes, to be fair, I wasn't sure we should raise in 2021, and I thought one good way to really figure out the trajectory of this embedded finance business. I mean, embedded finance started to be talked about. If you do a Google Trends search, and you see the mentions of embedded finance, you can see the hockey stick, right? I mean, in sentiment.
Got it.
And I really just wanted to see where the investment community was. And I remember going to Money 2020 in Amsterdam in October 2021 or September it was. I can't remember which month, but that sort of time. And my objective was very much to see whether our pitch was resonating, whether there is investment interest. My anticipation was, we'll close the year and then we'll start raising in 2022, and middle of 2022, we would basically, do our Series A. But I saw a lot of interest, and it started to feel like, here there is basically, this is the moment when everybody's so excited by this sector. Now is probably a good time to raise. And actually, Tiger is just amazing. The moment we had the conversation with them, actually, they reached out to us to be introduced to us at the same time as we asked for contacts to reach out to them. It was like in that week, I got a moment. Did I call you or did you call me? Type of moment. And they were very fast. In fact, we asked them to wait until we let the other investors catch up in terms of giving us term sheets. Again, we were oversubscribed. We originally were going to raise $20 million, but we ended up being very, very oversubscribed. I mean, multiple times. So we ended up, nudging it up and up and up, and then we decided to stop at $40 million. I was trying to get it done by Christmas, and there's a funny story here where one of my investors was saying, Alex, why are you so fixated on just having to get this done? I said, look, I don't take things for granted. I don't, once you're in that period when you've agreed terms with an investor, you want to get it all sorted.
Right.
And I said, you never know what's around the corner. I said, maybe Putin will invade Ukraine, and then the world economy will change. And it was a bit of a joke at the board, this one. In fact, this was Yusuf Ozalga, who's a partner at QED. And I think he put out a survey about what's in store for 2022.
Right.
And I think one of the options was, the war will strike out in Europe or something to that effect. And he said he did it as a sort of joke because of my paranoia. The thing is, the point is, you really can't take things for granted. When something is happening, you act. You don't wait to see how it plays out, because the world is volatile, right? And if you don't make your own weather, then you are having to be a taker of the environment you find yourself in. Now, if you find yourself in an environment, you do your best. But when you're at a point when the alignment is right, you act. You don't stop to think about things.
That's a good important how to manage that pressure and the timing. The timing is really important if you are not able to close a deal, and this also works on the customer side. If you are not able to progress fast at the right timing, maybe little bit later will not be anymore the right timing to proceed, right? So this sense of urgency, I would say, maybe that's the best expression, is really important as a founder. And also, as you said, there is the founder of Intel, who is the name, Andy Grove. Always I like it to talk about is to be paranoid. As a founder, it's important.
Absolutely. I mean, the point is, you have got to balance two things. One is being optimistic, thinking about all the wonderful possibilities that the future holds. Right. But at the same time,
not, you don't start a company.
That's right. That's right. And you need a drive. You need something to drive towards. But at the same time, you also have to realize there is so much risk that is going to get in your way, and it's the unknowns that get you, right. It's the surprises that you're not prepared for. So I think that having that sort of healthy sort of dose of paranoia at your side is pretty useful. Not just the vision and the drive to and the optimism.
Yeah, and you told me when we were preparing this session that you were also invested by the United Arab Emirates Sovereign Fund. So how did you end sparking the interest of this fund?
Yes, this is Mubadala, and they are a fund that is, I think, amazingly forward-looking, and they invest they invest thematically. They invest at multiple stages. I think we're probably the earliest stage that they would invest in. But when we were trying to think about the kind of ideal cap table, we always had in mind two criteria besides having investors we like, that have a good reputation. We also had two sort of aspects that was in our wish list. One is that we would be able to attract investors with deep enough pockets to be able to, do or participate in our Series B, Series C, and beyond. So that was one thing. And the second one was we wanted investors that were champions in a geography. So we started to look at investors in Latin America, who would be the type of funds that would be well regarded there in Asia Pacific, in different parts of the world. And we did speak to a number of them. I won't name names, but there in one case, we also did not take their money in this particular round. But with Mubadala, we really sort of felt that there was a really good alignment in terms of that wish list, if you like. So we made room for them in the cap table, and they've been extremely helpful with introductions, and certainly as soon as we're kind of ready to go in and roll out in the Gulf, especially, but also more broadly in the sort of Middle East, MENA region, then they're extremely helpful in terms of credibility, network. So I'm very sort of excited by having Mubadala on our cap table.
Right. As we were speaking, as we go through your journey and your also fundraising track record, so you check a lot of the boxes that VCs like to evaluate: kind of solid team, strong technical background, having really an IP and understanding a specific space, a booming niche that is growing, and then kind of going almost by the book in terms of fundraising, raising new rounds every 12 to 18 months. And then we know what started to happening in the second half of 22. The UK still remains at the top in terms of VC investment across Europe, but it was still, I think, 1 billion plus the previous year, and then we are also seeing what is happening in the US, and the VC market being very nervous and having a lot of dry powder, and a lot of LPs putting and VCs raising money from LPs, but now not investing so much. So, and then all the fears about the potential recession that we are still we are seeing the tech layoffs in the US from the largest tech companies. So how are you able to manage all of this, and at the same time you have raised a 40 million round, which is great because from a cash perspective you simply don't have the need and the pressure to raise a new round now, so that's a luxury to be in. But at the same time you also want to keep the pace of growth, so you want to raise another round to go even faster. So how do you manage all of these variables in the equation as a founder, and where is your thought process?
No, I think, first of all, I think you've done an amazingly good summary of the constraints. When we think about our planning, you have to take the capital raising environment into account. If you are very confident there is basically an accommodated capital raising environment, you can take really big bold bets. Maybe in acquisition, maybe in setting out new territories. I think when you have a situation as we have today, actually, I don't think it's a bad situation, because at some point there needs to be alignment between value created right in an industry and how that value is reflected in valuations. And of course, thinking about the future, thinking very positively about the future and the potential has the tendency to inflate the here and now. And at some point, the bigger the divergence, the bigger the correction that will happen, right? So I think it is just a fact of life that investors, entrepreneurs, the market doesn't get it right. At each moment in time, it gets it right eventually. Mm-hmm. And so right now, what we have to think about is there is basically a sense that rather than thinking about optimistically about the future, that everything will come right, all the value would get created, start to think about the evidence. And what that means is that you have to work in smaller sort of, if you like, chunks and gather the evidence. Now, when you do that, one of the advantages of doing that is that you can also be very frugal about the way you deploy capital. Rather than think about, I'm going to do this great sort of piece of technical development, or I'm going to do this great country expansion. It's going to take me 2 years, and I will then take stock. Right. And if it works, I'll do more. You have to do it in smaller chunks. You've got to test and learn with less, with smaller bets, if you like. And that's been our adjustment, right? So when we think about our growth, we think about the business as having a BAU angle, a business as usual angle, which is the engine of the business. So in that, it's all about how do we get larger customers? How do we reduce the sales cycle? How do we deliver more efficiently? That's really building out that engine. But then you're also making investments on top of the business as usual. And the size of the investments are definitely smaller than what we were willing to make when we closed our Series A. So we did a lot of work to actually roll out in the US. We decided to slow that down for 2 reasons. Yeah. One, the demand side in the US has been depressed because people aren't raising as much money as they used to. So they're building less, their projects are taking longer, companies are running out of money. And the second is because we think this change is going to bring opportunities for acquisition. So rather than just do it organically by building in the US, right. We see that there might be opportunities to team up with a team and that has successfully built a product, built the right kind of relationships, started to build a customer base in the US, and they could then become part of our whole operation. And at this point in time, given that we were to an extent lucky at raising when we did, we have that opportunity to be an active partner in that kind of roll-up of great businesses that have unfortunately had bad timing. Mm-hmm. So the US, we decided not to just continue to invest in there to go big. And we decided instead to put much more attention on actually rolling out in Singapore, which is a smaller market. It means it's 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 faster. It's faster to do business there. It's less of a huge bet to do it. And so we have continued to invest in expansion, but not in the biggest market in the world.
Right.
In the most business-friendly market in the world, Singapore, right? So that's been how we've adapted to that, and that's the way we look at the investments that we make. We haven't stopped doing them, but we're doing smaller ones. We're being more frugal, and we're doing this test and learn cycle, which is much more tight than if we were confident that we could actually continue to raise at ever increasing valuations.
Yeah. The listeners of the podcast know that I have a co-founder based in Kuala Lumpur, Malaysia. So I love the Southeast Asia region. We also have some guests from the region here. And it's incredible to see that also from that perspective, it seems that Southeast Asia keeps booming and raising more and more capital, especially compared to the West and what we are seeing in the West. We also see some conservative signs coming from China that has a huge impact on the region, but it seems that Southeast Asia is in a very different trend, and it keeps growing a lot, and will keep growing a lot in the next year. So we don't know what will happen in the next 1-2 years, and especially this year in 23. But it seems that the vibe and the energy that we feel in Southeast Asia is a little bit different from what we feel in Europe and in the US. And let's add China to the equation as well. And we also see the same in India, that is also booming and growing like crazy. That's kind of also your thought process when you look to Singapore and Southeast Asia as potential avenues for growth.
Very much so. I mean, look, Singapore grew 3.8% last year, right? The economy as a whole. That's pretty good going. And I visited Singapore 3 times last year, and it will be the same or more this year. Yeah. And you could see why, right? You could see that I visited in March, and all the meetings. I mean, I might as well not have visited, because a lot of meetings still have to happen remotely, even though I was on the ground there. I went again in June, and things were opening up. When I went there back in November, at the Singapore Fintech Festival, it was very much business as usual. It was like this pent up sort of energy just got released, and everybody's looking to do deals. Everybody's looking to return back to business as usual, and so that fuels demand, right? So that really felt completely different from my visits to the States, where the sense was, oh, we're in a different era now. Exactly. Money's tight. The IPO market has dried up. Basically, everybody's waiting to see who would blink in terms of investors, putting money into companies at valuations which were much lower than in the sort of go years of 2021. In Southeast Asia, I didn't see that sense. I saw the sense that finally we're seeing the end of the pandemic, and we're just going to get back to really building out and getting life back to normal.
And we were just seeing also the Chinese New Year sentiment, and the population was saying, yeah, we expect that finally this COVID wave will go away, and we are able to grow again as economy, right? So again, that is kind of the energy going on even in China, where things are a little bit more not so shiny as in the rest of India and Southeast Asia, let's say in the rest of the region. And of course, with China having the tension with Taiwan, with this problem that we have now with Ukraine and Russia, that has been our concern for a long time. But it's curious to see. The good news about Weavr is still targeting enterprises, or also another size of companies. So what is kind of the ICP of Weavr?
Well, I think embedded finance is a really broad concept, right? So wherever you have digital applications, whether that's for consumers or for businesses, there's usually at some point some money involved. If you're buying a house, you think about the house, but you also need a mortgage, right? If you're thinking about financing your education. You don't think about the financing first, you think about your education, but at some point you're going to have to think about financing it. And it's the same if you go on holiday. The last thing you want is to think about payments, but at some point to make your holiday work, you've got to think about what currency you're going to access and what type of holiday you want to have and how much you want to spend and all the rest of it. So embedded finance is a very, very broad concept. And we're only just starting to get our heads around how do you take financial services, how do we integrate them as a seamless part of these digital applications that help us get an education, find a house, go on holiday, right? Very, very broad. That means you have to make choices. As an early stage business, you have to make choices where you want to be able to dominate. And Weavr's focus is very much on B2B SaaS. We have sort of, if you like, in the last 24 months, when we look at the range of companies that have used us and which ones have been clearest in the way of unlocking value, we see a fantastic story for B2B SaaS, where a B2B SaaS company can multiply their revenues 2 times, 3 times per customer when they add financial services. And they can reduce churn by between 20 to 30% for customers that opt to take the financial service to the B2B SaaS business. What that means is, especially in the current environment, you think about you're a CEO of a B2B SaaS business, you've got depressed demand, right? You're less customers trying to reduce their costs. So looking at their SaaS stack and deciding, do I really need all of this? So there's going to be pressure on demand. What better way to protect your business by monetizing your existing customer base without having to spend more marketing money? In other words, your existing customer base, give them a reason to be more loyal. And be able to monetize them to the extent of 2 to 3x of what you're already monetizing them in a downturn. So there's a really great buying story. Right. For a CEO of a B2B SaaS business for embedded finance. This is if they make one investment during this downturn, this should be the investment that they make. Got it. Not double their marketing budget or reduce their prices and so on. This is the investment they should be making. Add more value, give you reason for your customers to stay on. So that's really what we're doubling down on at Weavr, right? It doesn't mean we don't support, other innovators that have great uses for our technology and our services to support consumers and other use cases. But proactively, our ICP is very much the sort of B2B SaaS. When I say B2B SaaS, I mean that in a broad way. In a B2B marketplace, for example, we would consider that within the ICP as well. Right.
So I would say more kind of mid-size kind of B2B SaaS businesses were scaling or already?
I wouldn't say mid-size. So we are selling to early stage companies, all the way to multinationals. This value story is big.
Got it. So the SMB and also an enterprise component for your solution at the moment, right?
Absolutely.
I was also asking this because of the Southeast Asia angle, because Singapore is kind of the capital of the enterprises that serve the region, right? But then the majority of the SMBs are outside Singapore in the region itself. So Singapore is great as a hub to land and conquer and even to focus if you are serving enterprise. But then going to SaaS, SMB, there is also the market is much bigger outside of Singapore in the region.
Exactly, and that's our logic, right? Start with Singapore. We will speak to companies large and small. I think the ones that are local present a more limited opportunity, but they're the ones which we'll probably get to market first. And then build out the banking capabilities across the region, mostly through partnership, and do it organically, driven by the demand that we are able to serve.
Right. And it's incredible how time flies. We are coming to already to the end of the podcast, but I still have a set of quick question and answers, a quick question and answer format to go through. And we were not able to discuss too much. I would love to pick your brain on kind of the fintech evolution and how do you see the future of the infrastructure segment, but we might need to do a second show and a second episode, especially after you raise the B round and you were able to tell another chapter of your story. But if you would have the opportunity to have a coffee with yourself at the beginning of Weavr, what advice would you offer to your younger self?
Yeah, quick answer is forget your clever tech, solve customer problems.
Love it. What are you the most proud of on your journey?
Yeah, I mean, look, as in any startup, there are many moments of glory, but also as many moments of despair, right? But what I'm actually most proud is I think the ability to just remain calm and thoughtful at moments of crisis. And it's something I only learned as a result of becoming an entrepreneur. I used to panic more before I was an entrepreneur, and being an entrepreneur, it was a kind of do or die thing for me. And that's something I learned. And actually it serves me really well in life as well, not just in building a business. So being calm and thoughtful is something, and at moments of crisis is something I'm actually quite proud to have achieved at a personal level.
Great one. I love it. I think that the advantage that we get out of the entrepreneurial journey for life and how much we get to know about ourselves is really inspiring. Worst advice ever received?
Well, there's some advice which is we all advise. Well, there's a lot of advice going around your side hustle, right? And so there's the advice, and I have received this quite a bit before I started building companies, which is keep the day job while your startup idea is still unproven. I think that's really bad advice, actually, because if you do not do it for real, you will not do it.
Yeah.
Now, there are exceptions to that maybe, but by and large, unless you throw yourself in that this stuff, you have to use all of your wits and all of your energy to make this work. The odds are stacked against you. You'll never quite know. You'll never quite know whether it would have worked or not. So that to me is really bad advice. If you're going to do it, do it.
Love it. And now the resources. Your favorite book?
I'll pick one, actually. One that's, I think, influenced a lot of entrepreneurs is The Lean Startup by Eric Ries. Yeah. That's a business book. If you want me to my favorite work of fiction is probably Gravity's Rainbow by Thomas Pynchon. I don't know how widely it's known now as a book, but it was hugely influential at its time, and I still think it's an amazing work of literature.
Absolutely. And favorite movie or series, as you prefer?
Well, at the moment, I'm really enjoying getting my head around actually a movie that was that basically was released 20 years ago. A movie called Mulholland Drive by David Lynch. Mm-hmm. It's a puzzle of a movie, and I think it's really great fun trying to unravel it. But if I had to kind of pick my guilty pleasure, it's probably Succession.
Got it. Good one. And finally, your favorite podcast, excluding this one.
I quite enjoy actually Harry Stebbings' 20-minute VC. I think there's a lot of kind of lessons at the same time. It's very sort of it's very kind of fun to listen to. On a more serious note, probably one of the non-business, if you like, podcast I've really enjoyed is The Coming Storm by Gabriel Gatehouse at the BBC. Okay. It's the history of QAnon and how that ultimately led to the storming of the Capitol, and I think it's just fascinating about the world we live in, where the ingredients of post-truth come from. So I think it's both entertaining as well as highly insightful. Well done, great one. It's a new addition to the list for sure. And Alex,
thank you so much for making the time. Your journey is quite amazing, quite inspiring, and a lot of lessons learned with our conversation. And I'm sure that we could have gone much deeper, but unfortunately, we have a time frame in the podcast world, right?
Mike, thanks for giving me the opportunity, and really enjoyed spending time with you today.
Likewise. And to our community, thanks for being on that side. As you see, we keep bringing you the best of the best to make your life a little bit easier as you scale your business. See you soon and keep scaling.